In this video, we are going to explore the middle path between actively managed funds and passively managed funds. And is there a middle path? Absolutely there is. These are funds which are called smart beta funds. Anything that's named smart is always attractive. Smartphone, smart TV, smart person, and smart beta. Wow, that's an attractive name. But it's also called factor-based investing. Now, what do we mean by factor-based? There are various attributes to mutual funds, and mutual funds that are put together on the basis of an attribute are called factor-based. A simple example is the top 100 companies by market cap are considered large cap by the regulator. Now, that is also a factor. The market cap in this case is a factor that determines which are the companies that are called as large cap companies. So similarly, there are a variety of different factors that are available. So smart beta investing is about combining the benefits of index and aligning it to one of the factors, and thereby coming up with a smarter solution that is not completely a fund manager play, but is not too far away from the passive index-oriented options. That's what smart beta investing is all about. Now, how does it work? We take an index, and on that index, the factor is applied, and therefore it is a combination of the index and factor. Let me give you an example. The most common fund that's available in the Indian equity mutual fund market that has used this concept is called equal weightage Nifty 50 ETF or index fund. Now, this is a classic example of a factor or a smart beta fund. Now, what the equal weightage Nifty 50 fund would do is that it will give a 2% weightage for every of the stock that is available in the top 50 in Nifty. Therefore, it constructs a 100% portfolio in which there is a weightage of 2% in every portfolio. The actual index may have a very different construct. In the actual index, Reliance probably accounts for 10 to 12%, HDFC Bank accounts for about 6 to 7%, so on and so forth. But in the equal Nifty, everything is allocated only 2%. Therefore, it is a little different from the passive index fund, but it has its benefits because it attempts to democratize allocation of money among the top 50 companies so that not too much of money is skewed towards one enterprise. This is one way of looking at factor investing. But there are many options that are already available. There is 30 low volatility Nifty 50 fund. What it means is out of the Nifty 50 companies, 30 companies with the lowest volatility among the 50 are picked up for investing. Similarly, you have funds Momentum 30 out of the Nifty 200 index. What it means is the fund hopes to pick up the top 30 in high momentum stocks that can give great value to investors out of the top 200 stocks in Nifty. So 100 of large cap and 100 top of mid cap funds form that index, and within that the top 30 with a high momentum. So you can have funds that are based on momentum, low volatility, equal weight, Nifty kind of products. You can have various combinations of these as alpha. So many different types of funds can be created. Now, all these funds serve investors a purpose. It provides a middle ground between a passive investment in mutual funds or an index fund or an ETF as the case may be, to an active fund manager managed funds. Let's face it, there are times when a fund manager managed fund is almost on fire. It's delivering stupendous returns, but it also goes through periods of time when it is exceptionally poor in its performance, even vis-a-vis the index. And same is the case with the index. Sometimes the index almost appears dead while the active fund manager is doing exceptionally well. the smart beta strategies try and provide a middle path by eliminating the biases in both. The excessive bias of an active fund manager is eliminated, while the excessive passiveness of an index is also kind of kept aside. To that extent, it brings a lot more vibrancy, but at a much lower cost as compared to a purely fund manager managed funds. So that's where the smart beta strategies are. They are relatively new in India. They're just making their appearance happen. So we should hear more about them in the coming days. As investors look at more options at investing, you will hear more about smart beta investing or factor investing as they are called. Now, a word of caution. Just because they are called smart beta does not necessarily make them smart. There will be times when passives will do well, and there will be times when the actives will do well. But when the passives are doing really well, the smart beta is likely to underperform the passives because it's a little different from the passive. Similarly, when the fund manager's active funds are doing exceptionally well, the smart beta may again underperform the active funds to that extent. So it's not a cure for all illnesses, as the case may be. It is just a one more strategy that one can look at as an option for one's investor. Who should look at these? Typically, people who do not want excessive volatility on their portfolio can look at this, but who don't want to just be in a passive exchange traded funds or an index fund can look at smart beta strategies as a good investment option to start with. Only time will tell as we go along whether smart beta strategies in India have really worked and have really given investors the returns that they had hoped for. It's early days yet, but let's wait and see how they are.